Hey everybody, welcome back to Race of History. We are going to get into a video today by the Plain Bagel. This is the first video I've done on the channel from him. He does more finance, economic stuff, which is obviously a little bit of a different lane from history, but he has a couple of different topics that I feel like overlap with history, and this is one of them, the 2008 financial crisis. This is what we're going to do today. It's 5 minutes, so this has to be the most simplified version of everything possible. But he also has one on the economics of the Great Depression, which is something I might look at in the future if anybody's interested on that. But this is what we're going to do today. 5 minute history lesson, the 2008 financial crisis. Let's get into it.
In the world of finance, we are often quick to forget the tragedies of the past, yet valuable lessons are to be had by exploring their causes and effects. After all, in a world of ever-changing rules, products, and services, history is the one constant that can guide us through the ambiguity. So let's take a 5-minute history lesson on today's Plain Bagel. It's the early 2000s, and investors are looking for new, safe sources of return. Stocks and bonds are still pretty popular, but the tech bubble at the turn of the century showed them that getting your money back from bankrupt firms can be a bit difficult. But what about mortgages? That's right, mortgages, the loan you take out when you want to buy a home. After all, for mortgage lenders, these loans are a lot like bonds with bonuses. You receive regular interest payments, and if the borrower defaults, you get possession of their house, which is a handy fallback because with real estate prices on the rise, recovering your losses is no problem. But investors don't want to buy the individual mortgages of Kate, Sue, and Bill down the road. No, my friend, that's where investment banks come in. These institutions, with their large capital and industry expertise, decide to buy up mountains of mortgages from lenders, pool them together, and then sell shares of the pool to investors as mortgage-backed securities, meaning that home buyers now pay investors their mortgage payments. Ain't that nifty? Investors sure think so, and soon enough people are flocking to investment banks to buy up their securities. And it's not just banks doing this. The government, in an attempt to boost mortgage lending, is using the Fannie Mae and Freddie Mac, two sponsored corporations, to do the same thing. Soon enough, lenders are facing a seemingly endless demand for their mortgages, which they're more than happy to part with, because every time they sell the rights to their interest payments, they get their money back, which they can loan out again.
So that's the big thing here, right? Is the bank is giving the initial loan for the mortgage, but whenever they push that, when they bundle it together and push that off onto another investor, they then get that investment off their books, right? And so they then are able to go out and do the exact same thing again, just continuously and continuously, right? The main thing here is keep in mind in the back of your head, this whole system works as long as asset prices, as long as home prices continue to increase, right? So as you're watching he's going to explain, I guess, kind of the system of how all this worked. Just in the back of your head, keep in mind, this is when prices are going up. So it works. In theory, it's a good system, but prices have to continually go up for this to make sense.
Mortgage lending and home buying kick into hyperdrive, and investors are getting pretty rich in the process. But other companies, seeing the gravy train running full speed in the investment space, are feeling left out, and insurers, wanting to cash in too, begin to sell credit default swaps, derivatives that pay out if a mortgage borrower defaults. It looks like a foolproof way of making money. In fact, why stop at just one policy per property when there are speculators interested in buying them too? Sure, selling 10 policies on the same mortgage may seem excessive and dangerous, but so long as we don't experience a collapse in the real estate market, it's free money.
Yeah, so I'm not going to get too into this, but basically this is a bet of a bet, right? The initial bet are the investors who are in the real estate deal, right? So you have the person that wants to take out the loan to buy a house. You have the investors that are giving them the money to do it. They're basically betting that you will pay off your mortgage, right? The only thing is, it's not terrible if you don't pay off your mortgage, because as long as real estate prices go up, then the house can just be foreclosed on and then they can turn right around and do it again. But they get their money back from selling the house if the mortgage is not paid. The deal here is with the derivatives insurance policies is these are just outside speculators looking in on that back and forth deal between lenders and home buyers and saying, we're going to bet that they will or won't pay their mortgage, that they'll default, whatever, right? And what ends up happening is this particular market of insuring these mortgages is massive. It's massive, right? People thought the real estate, like the real estate sector of the economy was in a bubble, but underneath the surface was this literally like metric ton of dynamite that were these credit default swaps. And if the real estate market went down, there were just all of these, speculators that had money on essentially it continuing to go up.
Soon enough, the amount of credit insured jumps from $900 billion to over $62 trillion. And while we probably don't have enough money to cover that, so long as things keep trucking along, insurers are making bank. And all is right in the world, with rising housing supporting this great supply chain that we've created. Or at least that's what's supposed to be happening. But something's changing. Because lenders are selling their loans, they've lost all incentive to avoid risk. And with such a high demand for their mortgages, they're starting to give loans to borrowers with bad credit scores and low income. And hold on a sec. Some of those subprime loans are predatory. Don't be fooled, borrower. That may look like a low interest mortgage, but it's chock full of terrible conditions. But the subprime borrowers don't seem to notice the fine print. And soon enough, everyone is buying a home, despite some having no possible way of paying off their mortgage.
Yeah, they were giving out what was called ninja loans. No income, no job, no assets. And essentially, you didn't have to have any way to be able to pay for this house, and they would still give it to you. And the issue here is they are going to start, there's only so many, good paying jobs for that could afford so many houses, right? And so if you have this huge demand to keep giving out mortgages, you're going to have to lower your mortgage standards, right? Or you're gonna reject the people who can't afford that house. But if you reject them, then that's less mortgages that you can then wrap up and sell to investors, and so then you're not making as much money. So instead what they do is they start giving these subprime adjustable rate mortgages where they essentially would entice people to refinance their home or sign a new mortgage where they would have this teaser rate that was extremely low, right? So people would look at the monthly payment and be like, oh, that's great, I can afford that. The thing is that it was just a teaser rate. And so after the teaser rate ended, the home buyer could wake up and, have a double, even triple house payment than they had before the teaser rate ended. And so obviously you have a lot of people who can't make that payment. They can't make that double payment, and their home ends up getting foreclosed on.
Investment banks are still gobbling up whatever the lenders are throwing at them, meaning that these ticking time bombs are making their way into the MBSs owned by investors. But that's not all. Investment banks are selling collateralized debt obligations similar to the MBS but riskier, and claiming that they're virtually risk-free, even as they fill up with these toxic assets. But that's not all again. Despite there only being so many mortgages to invest in, people are using complex derivative investments like synthetic CDOs to bet even more on whether people will make the mortgage payments, which in case you haven't noticed, is becoming less likely. Now, surely the rating agencies will notice the heightened default risk and let investors know, hey, by the way, your holdings are full of crap.
Okay, so this is actually what I wanted to touch on. Ratings agencies are not known for being extremely on the ball with investments, okay? There are Chinese real estate companies right now that are defaulting left and right. If you go look at their ratings, they don't always reflect that, right? And so that's what happens here. You have some of these extremely risky loans, right, that are rated way higher than they should be by these ratings agencies. And I mean, what do? If you're an investor, you invest in things based off of what the ratings are, what the risk is, right? What is the return and what is the risk? That's what you're trying to calculate. If you have a faulty risk assessment, then that throws everything off. And so you're selling these to, people, you're giving these to people's 401ks and retirements and all this sort of stuff, with them thinking that they're holding super safe, non-risky assets, when in reality the assets are extremely risky. And the people who actually had dug into this at the time knew it's literally just a matter of time until this explodes.
But wait, are you kidding? AAA safety rating? Well, everyone, we've done it. We now have a system where lenders don't care about whether mortgage payments are made, investment bankers don't care about risk, and the rating agencies, designed for the people but paid for by the banks, don't care about investors. And for a while, this web of liability and risk holds firm, but it's only a matter of time before the subprime borrowers start to default. And by October 2007, 3% of all US home loans are in the foreclosure process, with another 7% 1 month past due. Mortgage investments are starting to turn into real estate, and investment banks are flooding the market with foreclosed homes. Soon enough, supply is starting to outpace demand, and in 2008, housing prices do something that nobody prepared for. They start to free fall. And so begins the domino effect that was the 2008 financial crisis. Finance companies involved in the real estate game take a hit. And despite 75% of CDOs receiving the highest safety rating, 70% of them default. Investment banks, seeing the carnage they've caused, stop buying mortgages from lenders, and the insurers find themselves facing impossible payouts. Banks, lenders, and insurers start to shut down. And despite the government trying to save the largest players from the brink of destruction, on September 15th, we see the largest bankruptcy in US history, as Lehman Brothers, an investment bank with $600 billion in assets, goes under. At this point, anyone with money to spare pulls it out of the markets and places it into treasury bonds, which leads the Dow Jones to lose a third of its value. And companies rely.
Yeah, and so this is decently common, right? Whenever you have extremely high volatility in the stock market, a lot of times investors will try to hide in treasury bonds. That's, that's pretty common. And the reason why I felt like the reason why I wanted to do this, if not today, sometime soon, is because we are facing very uncertain economic times right now. If you live in the US, if you live in the Western world in general, things like insanely high housing prices, rising interest rates, the amount of liquidity that's being taken out of the system by central banks, the amount of leverage and debt that all consumers and businesses seem to be, living on. The Chinese market being half locked down, the real estate market not being able to hold itself up. There's just there's a lot of uncertainty, right? And especially in regards to the housing market, I hear all the time, there can't be a housing market crash as in modern times like today. There can't be a housing market crash because there's just too little inventory. And what 2008 showed us is that inventory can flip really quickly. Like, as soon as people start looking at houses as debt and not assets, that flip can happen, real quick. Investors start offloading their second, third, fourth houses. Investment banks start unloading neighborhoods at a time. It can compound on itself very quickly. And that's what happens here, right? When you have the supply of houses for sale that catches up with and then overpasses demand, you have a shrinking of house prices, right? Obviously, because if there's more houses for sale than people that want to buy them, that's just simple supply and demand, right? So house prices have to come down. And the thing with that is it's very easy to say, like, if the market starts to shift, I'll just get out. But in a situation like this, the market shifts so quickly that by the time you notice what's going on, you may not be able to get out, right? That's the deal with the stock market too. It's like, okay, well, if the stock market starts to crash, then I'll just sell my stuff and get out before I lose too much. Well, people have to be willing to buy that stuff from you in order for you to sell it and get out. And if the stock market's crashing, then there may not be any buyers on that end, right? And so it's just it's sort of a precarious situation, and I hear a lot of like rationale about why things are different today or why this stuff couldn't happen today. And I agree that the system in general is different. You could look at things like standards for mortgage lending from banks, although if you go to commercial lending, it looks an awful lot like pre 2008. Um, but it's not, you don't always see what it will be. Like in 2008, it was subprime mortgages, it was CDOs, it was things like that. But it doesn't have to be the same thing to basically cause the same issue, if that makes sense.
Relying on loans to operate suddenly lose access to vital financing. Countries with ties to the US are caught up in the disaster too. And by 2009, the global economic engine stalls. 2 million American jobs would be lost in the last 4 months of 2008 alone. And while the recession would technically end in June 2009, the impact of the crisis would be felt for long afterwards. And the kicker to it all, despite financial institutions causing the whole disaster, they received the most money from the government's rescue attempts. While the Dodd-Frank Act would be introduced in 2010 to crack down on the lending practices of financial institutions, one would hope that we never again need regulation to remind us that greed should never trump common sense and decency.
Okay, so that was a pretty good general explanation of what happened. Um, Matt Taibbi has done, he's a journalist, he's done a lot of deep diving on the 2008 financial crisis. The way he describes it is uh, he says, I started to understand it when I stopped looking at it like an economic story and started to look at it like a crime or fraud story, something along those lines. And I mean, really, the issue here is the overall thing is you couldn't not know if you're giving these subprime mortgages out to everybody. You can't not know that like that's not going to last forever, right? But you had people who, I mean, really, really believe that the housing market only goes up. It's extremely stable. It's illiquid, so you don't have quick investors trying to get in and stuff like that. But the deal with these things, with the derivatives markets, with the CDOs, with the influx of major investors coming over into housing, you kind of have this intermixing of two markets. You have this intermixing of the you know, volatile and liquid stock market and investment market. And then you have the safe, stable, illiquid housing market. And they're sort of just over time getting more and more and more mixed together. And I think overall that's probably not a good thing. It makes volatility rise in houses. It makes it, more likely for another crash and things like that. In reality, I don't think there was any way that the banks didn't know what was going on here, right? There are a lot of people who could feign ignorance throughout this whole thing. The banks are not one of the groups that I think that is a legitimate argument. And not just that, but they did get the most bailout money by far, by far. Instead of bailing out the people who had taken these mortgages, having them pay off their mortgages and sending the money upwards that way, they literally just, the Fed pointed a money cannon at the banks to keep them afloat. And it's probably one of the most controversial decisions that U.S. finance has ever made and that the U.S. government has made in the last, I don't know, 40, 50 years, something like that. I'm curious what everybody thinks about this. If you have any other insight or questions or anything like that, put them down in the comments. As always, like, comment, subscribe. Help me keep building the channel over here. I'll put the link to the Discord down below, and I'll see you all next time.